I think I met most of you guys already, but for those of you who haven't got a chance to meet yet, my name is Felix, and today I'll be talking about the financial crisis. As some of you may know that I graduated from college not long ago, and one of the big differences that I noticed after college is that I have a lot more free time right now because I don't have to worry about the homeworks, exams, or the classes that I was not interested in. And with all the free time, I picked up a few new hobbies, and investing is one of them. And to keep up with the market, I read a lot of the finance news in order to keep myself updated. And recently, I heard a lot of people talk about the next recession is coming soon, very soon. And that's why I chose this topic to talk about today. Well, don't get too excited yet, because I won't be able to tell you when exactly the next recession is going to be. But instead, what I'm going to talk about today is the housing market crash back in 2008. And I hope this is going to give you a basic understanding of how a financial crisis is initiated, is built up, and finally exploded. And before we get into the details, let's have a finance 101 to get started. So all companies started out as private companies. For example, Apple started out as a private company in Steve Jobs' garage. But as the company is getting bigger and bigger, they need more money. So private organizations normally raise funding by issuing stocks through IPOs. And the stock price normally depends on the value of the company. So when people think that the value of the company goes up, the stock price for the company normally goes up as well, and vice versa. So basically the shares of the stocks is equal to ownership of the company. And now you may want to ask, so if I buy Amazon stocks, does it mean that I can sit next to Jeff Bezos in meetings? The answer is yes and no. If you own 1 million shares of Amazon stocks, yeah, you may be able to do that. But if you're noobs like me who only has like 1 or 2 shares, you're probably not going to be able to do that. And other than stocks, another type of investment is called a bond. So what exactly is a bond? Well, it's exactly what it sounds like. It's like a bond between 2 parties. It's a contract between 2 parties that offers a lump sum payment to the investors in a predetermined date. And unlike stocks, the value of the bond does not really decrease based on the value of the company. And that's why bonds are considered a safer investment compared to stocks. So do you guys think the housing market is more related to stocks or the bonds? Take a guess.
Bonds.
Yep, exactly. And now let's look into the housing market. It all started out in the late 1970s. A legendary banker called Louis Ranieri invented something called mortgage-backed security, which is a type of bond that connects the home buyers and the investors, which is a game changer on Wall Street back in the days because it brought in so much money to the banks and to the bankers. And that's exactly the time frame when the hangout spot for the bankers changed from the country club to the strip club. Because they have so much money to throw. So what exactly is a mortgage-backed security? And how is that tied into the housing market? Well, I think we all know that in order to buy a house, you need 2 things. One is the down payment, which is about 20% of the home price. And then we go to a bank to take out a mortgage. And then we pay back the mortgage every month for the next 30 years. But the banks don't really want to take on all the risks because some home buyers may not be able to pay off the mortgage every month. So what do the banks do? Well, they collect all the mortgages together and then they separate them into different piles and categorize them based on the risk level. For example, the AAA pile is considered to be a lower risk because it contains all the home buyers who have high FICO scores or steady income histories. But on the other hand, the B pile is considered to be more risky. And after they rate them, they call them trenches. And then they issue these trenches into bonds. And that's the mortgage-backed security. And who buys these bonds? Well, individuals like you and me can buy them. Retirement funds of 401k companies like other big management companies buy them as well. Even the banks buy them back as well, because the return for the bonds is really high and it's considered a safe investment, because who doesn't pay the mortgages, right? And by looking at this flow, it seems like a reasonable, very reasonable process. At least I don't see anything wrong with it. So what exactly happened in 2008 that turned this great investment into a mess? Well, there are two problems here. One is this investment is way too good. Two is that the people on Wall Street is greedy, and these two things don't go well together in the long term. Because the banks, not only do they get commissions from creating these mortgages, but also they got a huge return from buying these bonds. So they have a huge incentive to create more of these mortgages. But the problem is, there are only so many good home buyers in the US. What can they do about it? Well, there's an easy solution for that. They just gave out the mortgages to almost everyone who applied. Even high school dropouts can get them back in the days. And now you may want to ask, okay, Felix, can we just give a C rating to the bond or to the mortgage that is from the high school dropout and no one's going to buy them? Well, in the ideal world, that's supposed to be how it works. But one thing I forgot to mention is that the rating agencies like S&P or Moody's, those are private organizations. Those are the ones who give the trenches ratings. Imagine if a bank comes to S&P and they don't get a good rating for the mortgages, what do you think they're going to do?
They're gonna
Bump the interest.
Not quite.
they're gonna go to a different
think, Gary?
rating agency.
Yep, exactly. They would just go down a couple of blocks to go to Moody's, get a better rating for that. And now you want to say, okay, Felix, this sounds too crazy, but isn't all this regulated on Wall Street? Yes, they were regulated, but the banks are really smart. They have ways to go around it. So what the banks do is, for the C trenches that no one bought them, they just collect them back and mix them together, and they consider that diversified enough to mitigate risks. And then they go back to the rating agency to get a better rating for that. It sounds crazy, right? But that's how it worked back in the day. So what is the result for all this in this messed up process? Well, the mortgage with high risks continue to build up, and the home price skyrocketed back then, and then the mortgage default rate just continued to increase. In 2006, the mortgage default rate is 1%. In 2007, it went up to 4%, and it only needs the mortgage default rate to go up to above 4% to cause the entire market to collapse. And guess what happened in 2008? It did exactly that. It went up to as much as 21% at one point in 2008. So after that, what's the aftermath? One of the biggest investment banks on Wall Street, called Lehman Brothers, went bankrupt. About 8 million people across the US lost their jobs because of this. And billions of dollars were lost in the retirement funds because they thought these are the safe investments and bought them. And now we're officially into the Great Recession. I don't know about you guys, but I think the evil player in this crime scene is the Wall Street. So what are the punishments on Wall Street? Well, thousands of the bankers were sent to jail because of the Criminal Act. And the big banks were broken down into smaller ones, so that they're not as powerful as they used to be. And the regulations on Wall Street become really strict after that. We think that these are the right thing to do, right? And I think they should do that. But the sad truth is, none of this happened. So what exactly happened after the fact? Well, only one banker out of thousands of them who actually went to jail for this Criminal Act. And some of the banks lost money. Well, some of the banks and the bankers got fined for what they did, but that's only a fraction of what they have made by taking advantage of the average people. And some banks lost money, so they merged together to save themselves. And today, they become even stronger. So who do we blame? Well, we blame the poor people. We blame the immigrants, just like we always do. So what happened to the regulations on Wall Street? Well, we become a little bit stricter, but not by that much. So if you ask me if when the next recession is going to be, my answer is I don't know, because I truly don't. But if you ask me if the next recession is going to come, my answer is hell yes, it will. It's not a matter of if, just a matter of when. And that concludes my presentation. Thank you.